Yeah.
Good morning. Thank you for tuning in to Sunbelt's live telecast. We have been talking over the last few weeks about business operations. In fact, our last session was on operating your business so that you can exit it when you're ready and at your own time and for the amount of money you need for your retirement or for your next project. Now, over the next few sessions, we're going to be talking about the actual process of getting your business ready to go to market, and we're going to be talking about 4 steps that you should consider and take in that process. And today, we're going to be covering 9 things related to legal, tax, and housekeeping items that we're going to be considering, or that you should consider to help you get the very best price for your business and the very best terms. Before we do that, we have a little legal and, well, not legal, but housekeeping items that our producer Keisha wants to talk to you about how you can contact us and that sort of thing. And there she is.
Hey everybody, I'm behind the scenes and ready to answer any questions or at least apply it to our team here. So if you have any questions, you can type them in the comments and I'll address the team, and you can always message us that way. All right, that's it.
Okay, so your goal then is to eliminate or address any red flags that might come up and scare off a potential buyer. The first thing we want to talk about, we'll be talking about 9 of these items, and we'll cover some of them, maybe in the same conversation, but we'll try to mention all 9. The ownership documents. These things should be current and correct and prepared in the proper way. And I think Berlin has had some experience with those sorts of things. So Berlin, what experiences have you had?
Well, with the ownership documents, we find quite often that the way that a business runs their day-to-day operations may not necessarily work when it comes to selling the business. I had a situation where I was selling a business that was a twofold business. There was one part of it that was a C-store and gas station, stuff like that, and the other part was another business altogether. And between the two, the accountant was keeping the records from both of them together. And so when it came time to sell, it was an absolute nightmare to try to get these records separated because they just hadn't done that for 30 years. So it's important that your profit and loss statements, even if you file your taxes current or together, that you keep your P&L separate from the different business entities, because the buyer comes in and wants to see how the store is doing or what's going on in the gas station, and if you combine it with the other store, it just didn't make any sense, and it was just very difficult to try to get that separated. So, and that cost us about 3 months in getting the business sold and getting the business put together. And the other part of it, or the sale put together, but the other part of it is that quite often the businesses are set up in creative ways. That was a nice way to put it, right?
That's the new word, creative.
So when you talk about putting your business in a corporation, make sure that you get legal advice on that from your attorney. Make sure you talk to your accountant to make sure what's going to work best for you, especially as you're entertaining the idea of selling and moving on, so that you can, is a C Corp best for you? Is an S Corp best for you? Is an LLC best for you? What's going to work best in your situation and your circumstance? And what may work on your day-to-day operation may not necessarily be the same as selling it, because if you sell it with the wrong kind of corporation, there's tax implications that can create a real hardship for you. So make sure you get good legal advice on that. We're not the ones who give you the legal advice, but we have seen what happens when you don't get the proper legal advice and what the problems can be.
Yeah, and accounting advice. We see a lot of businesses that are ready to sell, but they're a C Corp. And people don't realize that a C Corp is not what they call a pass-through entity. The money goes into the C Corp and you pay taxes on it at that point. Mm-hmm. And then the owners, the shareholders, they have to get the money out. And when they get the money out, they pay tax at a personal level. So it's very important to consider these sorts of things and not get yourself stuck with what we call double taxation. There are some things we can do to help owners when they haven't thought that through. But if you're thinking about selling in the next 5 years or so, you should probably talk to your accountant, and you're a C Corp, you should probably talk to your accountant about converting to an S. It's just an election when you file your tax return. So that takes care of the first two items.
Now, John, doesn't it take a while though to switch from an S Corp or C Corp to an S Corp?
No.
One tax season.
I mean,
one tax. When you file your return, there's a little box.
Mm-hmm. But for the purpose of selling?
No.
No, okay.
No, but what does take time is there's a 5-year hold.
That's what I was asking.
Right, yeah. So what you have to do is you have to evaluate your business at the time you switch from a C to an A. And then when you sell your business, for the first 5 years, it goes away after that. Mm-hmm. But for the first 5 years, when you sell your business, you take the value of the business at the time you made the election, and you will pay C Corp taxes on that portion. Anything above that, you will get the S Corp treatment, the pass-through treatment. So it's a big deal. And really, if people are doing exit strategy planning, better to plan 5 years in advance.
Right.
Which most people don't do, but we encourage people to do that. Okay, number 3 is you need to make sure you can deliver clear title to all your business assets. Now, we've had a lot of experience in that. There's a little form, it's a state form that's recorded with the Secretary of State, and it's called a UCC1, Uniform Commercial Code 1 form. And what that form is that's a lien form that liens, say, a piece of equipment at state level. And when you get ready to sell your business, you're going to be going through escrow, probably a bulk transfer escrow, and there are going to be all kinds of searches done, and the state level search will be done. If there is a UCC1 recorded on a piece of your equipment, you're going to have to get that released before you can transfer that piece of equipment, because you don't have clear title to it because it's got a lien on it. That's just an example. Of course, sometimes people haven't been keeping their taxes current, their EDD, employment development taxes, employee taxes, also franchise taxes, sales tax, that sort of thing. You certainly have to keep that current, and of course your income tax. Those all have to be current.
I got one of those also. You won't think about it until you go to sell. But I just recently had a sale, and there was a piece of software essential to the operation of the business. And the software was established or set up with the manager of the business. And the software company only recognized the manager of the business. They thought that that person owned the software. So when the buyers came in and wanted to utilize the software and transfer it into their name, they wanted the old manager's signature and approval to make that change. The software company wanted the old manager's approval to make that exchange. Well, the old manager had been fired months previous, and that person didn't want anything to do with this company, didn't want to help them in any way, and so it was a horrible mess. The owners are saying, we own the business, this is our software, and the software company is saying, our records show that so-and-so is the owner of this software, and we're not going to make the change, you can't do it. So in advance of trying to sell your business, make sure you own all the assets necessary to operate your business.
And that drifted over into the fifth topic that we want to talk about, and that's having any of your business licensing or regulatory compliance violations taken care of as much as possible. In this case, it was ownership of the software used to operate the POS point of sale system, and they just had to get a new system, didn't they?
The owners bought the business or negotiated the sale of the business, and then on top of that, they had to buy the operating system or the software to operate the business that they just bought. So they paid for it twice. It was a terrible, terrible mess.
Yeah, and so that sort of thing those are the things you need to think about, you know, and we help you with that as much as we know. We ask questions, but we don't always get all the proper answers to the questions we ask.
Right.
Yes.
And so in this case, it caused a little bit of trouble, but that wasn't the only issue with that. There was more trouble than that. But anyway,
You'll hear more from me later.
on that issue. Let's see. So number 6 is that's a big red flag is your taxes. And there's lots of reasons why that can be a big red flag for a buyer. So Carol was going to talk to us about that.
Yes, what happens a lot, I talk to somebody on the phone, they want to sell their business, and of course we want to know what the total sales are. We want to get an idea of what the business is worth, but obviously what someone says, or maybe if we're given some P&Ls, that doesn't always tell us everything. So we ask for the taxes. That's one of the things that we ask for, usually the last 3 years, because that's something that a buyer can bank on. Because one of the things that they're going to ask us is, what are the last 3 years of tax returns? You know, so that they know it's been filed, they paid their taxes, they have expenses, they have income. We can break things down through other documents, but the taxes tell the full story. So that's what we need. We have to have that. So that's among a few things that we ask for from sellers.
Right.
Puts the buyers at ease.
We do adjust those tax returns because, you know, we tell buyers that tax returns are really prepared for only one reason, and that's to pay as few taxes as you possibly can pay. So they may not tell the full story of the business, but certainly the business is making what the bottom line on the tax return is, for sure. And we have a process we use, we call it normalizing the financials, where we make adjustments that are appropriate for sellers, such as automobiles that are really the seller's personal automobile, cell phones that are being used by their family, things like that, medical insurance, all of those sorts of things can be adjusted so that we arrive at this thing we call seller's discretionary earnings. And so even though your tax return may not look so good, we can, after we work our magic with your tax return, it'll look a lot better than it looks. And everybody does this on there. That's one of the perks of owning a business.
That's
is
right.
you get to do that.
But
There's
it
a-
allows us time to talk with you after we review the taxes, so we can learn what we're going to do with that, so that we know what to show the buyer and to show the worth of the business that you have.
You know, a thought on that is that if you're preparing to sell your business, you might want to sit down and make a list of those items that you run through your business. Vacations,
Personal.
cell phones, whatever perks you take out of the business. If you can itemize those, it makes it a lot easier to be able to put that on your
Sure
on
does.
SDE. So
The only thing we can't adjust is if you've got a cash register and money is being raked out of the cash register. We can't see that. It's not reported as income. That we cannot adjust. So we can adjust things that appear in the expense area, but we can't adjust the income area.
Yeah.
So there is a form. Some buyers get a little nervous about the tax returns that the seller provides them. And there is a form that the seller can provide a buyer. It's called a 4506T form. It's an IRS form, and you can send it to the IRS. What that means is the T stands for transcript. And you can get a transcript of the tax return as long as the seller authorizes you to do it. It takes about 10 days. And a lot of times we'll use that. And if you're doing an SBA loan, they're going to use it every time. They use it every time on an SBA loan. So, and that just makes sure that the return that the seller is showing you is the same return that they sent to the IRS. Because it's real easy to prepare a tax return. We got all kinds of programs out there now, TurboTax and these things. People can gin up a tax return pretty easy. So not that any of our sellers do that, but never. But some people get a little nervous about that they might. Another thing, an area which is one of our items that we're talking about here, is your receivables. Sometimes you're going to transfer receivables. Sometimes you're going to keep the receivables. If it's an asset sale, the chances are you'll keep your receivables. But usually the seller will collect, or the buyer will end up collecting those from you or for you. But receivables can be a problem. They can be problematic in the sale of your business. And I think Carol wanted to talk to us a little bit about that.
Well, I think there's delinquent accounts that a buyer isn't going to want to take, or they're going to see that as, oh, you weren't watching those delinquent accounts. That means if I take it on, I have to go after and get those. And, why would a buyer want to come in and take on all of that? What was the other thing we were talking about with regards to delinquent accounts?
Well, the weakness, it shows everybody wants to buy a business that has good, reliable customers and clients. But if you've got a lot of 90-day, 120-day receivables, that means it's going to be that much longer before your receivable comes in. That means you're going to need more working capital to operate that business. I'll tell you who's really notorious for not paying the receivables on time. Verlin knows this because he's been affiliated with these companies, oil companies. Mm-hmm. Oil companies. I'm sorry if any of you work for an oil company. But anyway, oil companies are the worst. They always make you wait. Now, they're good receivables.
Oh, they will pay it.
They're going to pay it.
On their time, and they will not pay late fees.
Right. Yeah, and they won't pay late fees. And so you're going to be floating those receivables for a while. So it affects your operating capital in your business, right, Russ?
Absolutely.
Right. So, and you got to look at that. So you're going to need more operating capital for a business like that.
John, another point with that is that if somebody comes in, you have a lot of receivables, they're going to want a discount on those, even if they are current, because there's always a degree of risk.
Right.
Yes.
And they're going to balance that degree of risk against what they're going to pay for it.
Yeah. Every business is a little bit different. Dry cleaners are interesting because, you have all that stuff hanging on the rack that you've dry cleaned and you're waiting for people to come and pick up. Surprisingly, some people never come and pick up their dry cleaning. And so what normally, the way they work that in that business is if it's been hanging on the rack for less than 30 days, then they'll pay 100% for it. If it's like 30 to 60 days, then they're maybe going to discount that 50%. And if it's 60 days or more, they'll pay nothing for that. Because the chances are they're not going to come and pick it up. And every business is a little different that way about how they handle their receivables. Like for a company that does business with oil companies, there's not that much risk that you're not going to get paid. You're going to get paid. Well, I don't know that.
That was
It's
just keep going.
Don't worry about that, huh? We just had a little glitch over here, but we're not worrying about it.
Pay no attention to the girl behind the curtain.
No attention to the glitch. Let's see, number 8. This is another area that we've all had experience with, and this is your leases. You need to have your leases in order, and they need to be current, and you need to know all kinds of provisions. You know, there's all kinds of provisions about assigning leases and things like that. In a lease, you need to know what they are and what the cost is going to be and all that sort of stuff. Russ has had some experience recently. I think it was in that same deal.
It's the same deal.
Same deal.
This deal was the deal from hell. It was terrible. It was awful.
They're not all like that.
So the owners, the sellers, had negotiated a lease, and they were operating on this lease. They were 3 years into a 5-year lease, and they intended to assign the lease to the buyers. And typically, when we negotiate a lease, especially an inexperienced lessee is going to negotiate the lease based on the price per month and maybe the escalation, how much it goes up every year, and that's pretty. Or maybe the CAM charges. You might talk a little bit about that with the landlord. Those are the 3 things that you typically talk about in the negotiation of a lease. Well, there's this 4th thing. It's called the assignment clause. And in this case, there was a 15% increase to the lease amount, the monthly lease amount, 15% if that lease was ever assigned to somebody else. Well, when somebody buys a business, they want to continue in that space because all the customers know where you are. They want to stay there. And these tricky landlords stuck in a 15% increase in rent if they were to ever assign that lease. And the 15% increase is bad enough because typical escalation or increase in rent per year is 3%. They had 15%, and once you pay the additional 15%, every annual increase after that is 3% on top of the 15%. So it's a huge cost to the people who intend to purchase the business. Now, in our case, because I saw that clause and recognized that as a negative, I told the seller that we're not going to try and assign the lease. We're going to try and negotiate a new lease. And so that was our pitch to the landlord was, no, we don't want to assign this lease. We don't like this lease at all. We want a brand new lease, and we're going to give you another 5 years on this lease, landlord, so that, you know, you don't have to watch this business fail and go belly up and not get any more rent. We're going to come in and negotiate additional time on a new lease, and that's what opened the dialogue with the landlord. In this specific case, we negotiated the lease and we ended up having the assignment, but we actually paid a cash penalty so that the actual lease rate, the rent every month, didn't go up at that 15% and continue on after that, 3% on top of the 15 thereafter. So the landlord got a nice chunk of money out of the sale, the value of the transaction. They got paid, so it was kind of a penalty to the poor seller who didn't really negotiate the lease very well. So it's something to look at. Look at all of the clauses in your lease. If you don't understand the lease, call us. Call us or call a commercial real estate agent. We can review with you what your lease means and maybe offer you some advice as to how to negotiate it better so it will better sell the business.
Okay, and well, let's see. I think our producers don't hurry up. Anyway, we got so we talked about that, and then resolving any outstanding lawsuits or legal problems that you might have, like workers' comp, that sort of thing. That can be very problematic. I've got a hardware business right now that the guy wanted to list with me, and I told him, but he's got a workers' comp claim, and it's an open end. Who knows? And no one wants to. A buyer doesn't want to take that on. Oh, here, let me sell you my business, and you handle this workers' comp claim, and I'll go on about my business and I'll worry about it. Well, you're not going to find a buyer that's going to be too anxious about doing that. So I recommended that seller wait and get that thing resolved. And he did, but then he wasn't nearly as anxious to sell his business.
No, the business is great.
Strange thing, you know.
Yeah.
So,
Hey, John, can we take one step back on the leases? One of the things that you have to remember is that the SBA has requirements on leases, and I just wanted to bring that up. That SBA is going to require a 5-year plus another additional 5-year after that option.
if you want a 10-year
If you want to get an SBA
amortized
loan.
loan,
Yeah.
they'll just shorten the term. If you've got 7 more years to go,
Yeah.
then you'll get a 7-year term on your SBA loan. You know what the problem with that is?
Increases your payment.
Your payment's higher,
Yeah.
and so your cash flow is less.
Yeah.
So a maximum of 10. Of course, if you're buying the real estate, you can sometimes end up with a 25-year amortization. We encourage people to buy their location if at all possible, if it makes any sense, and it usually does.
Right.
Okay, so, well, we hope that this has been helpful to you, and we are trying to bring value to you, and we'll have 3 more sessions on this. Maybe not that many, but we want to cover 4 steps that you should take. And next month, on the 7th of January, that'll be our next live telecast. We'll be talking about step 2, which is boosting your bottom line, and there are various ways that you can do that and how you'll go about that. We want to wish you a very Merry Christmas and a Happy New Year, and we'll see you next month.
Merry
Bye.
Christmas.
Merry
Or next year.
Christmas. Oh yeah, next year.